All right, let's dive right in.
All right.
It's good to have everyone here. We'll send out the presentation to those who come in late or couldn't attend. You want to introduce yourself, Jay?
Sure. My name is Jay Jacobs. I'm the CEO of Align Infrastructure. Our focus is municipalities, universities, schools, hospitals, mostly on the public side, but we're also focused on the private sector, in particular, publicly traded companies and what I'll call semi-permanent companies. All of the above need to be of significant stature. We're not focused on a business where the initial order would be below $15 million in total invested capital. Our preference is projects that are $50 million or higher. Obviously, the bigger, the better when it comes to infrastructure. And at the moment, capital is abundant for projects like ours. So thank you for joining us. Our solution is what I would abbreviate as save now, pay less, in the sense that our biggest competitor is the customer does nothing, even though their infrastructure is failing. And we'll get into the reasons for why that occurs. And so our solution is to put infrastructure in now. And by putting it in now, the customer wins and everyone else wins. And so our solution is the lowest cost, lowest risk solution in that space. Thanks, Roy. If you can, next slide. So I won't spend much time here. We know this is a big problem. On the left is a photo of the disaster that happened in South Florida. And on the right is a photo of the Northern California wildfires. Just a brief anecdote to that. The place where I'm speaking to you now, my home and farm, we were in the Northern California wildfires at the end of February, and it did burn our property. It burned our farm. So I'm personally involved. That fire, by the way, occurred because of a failure at the utility company, PG&E, and the impact of climate change. So this is important to me for many reasons, but it's increasingly important to others. And though this is a $1 trillion problem, this problem is growing, and it's growing quickly. So despite the fact that it's a big problem, it's a problem that's getting bigger with an increasing sense of urgency. Thank you. Next slide, Roy. So you've heard big numbers. And so this is the big number slide as it relates to the problem. The one thing I'd love you to take away from this presentation is an understanding that there is a long-held belief that has been reinforced through many studies over the last 30 to 40 years, which shows that for every dollar which is not spent on deferred maintenance and on replacing assets that are about to fail, for every dollar you do not spend, it ends up costing you about $4. That's an important equation to keep in mind. So for every $1 that a city, county, state, private or public company doesn't spend to upgrade the infrastructure that they should spend, it will eventually cost that customer $4. And the standard deviation of the $4 is $3 to $30 for every $1 you don't spend. The result of that is for cities, counties, states, hospitals, prison systems, airports, publicly traded companies who are not spending money to upgrade their their old critical infrastructure to new infrastructure, it will eventually escalate their long-term operating expenses at an increasing rate. So keep that in mind as we go through this presentation. Next slide, Roy. So between now and then, our experience in speaking with potential customers like the state of California, the state of Texas, the county of Los Angeles, the county of Cook County outside around Chicago, public and private companies, is that up to 95% of the projects they should do, they're still not doing. And the range is typically 80 to 95%. So 8 out of 10 to over 9 out of 10 projects, which they should be doing now, they're waiting to do. And there are many reasons for that. I'm going to focus on just one of them for the moment, and that's time frame. If you're a CEO of a company, or if you're an elected official, the average length of time that you will be in that office is somewhere between 4 and 5 years. And if you have a limited capital stack, a limited amount of money, the question is, would you take some of those funds and put it towards upgrading your infrastructure when in fact the payoff from that investment is unlikely to occur until after you've stepped down as CEO or after you're no longer in office? The answer is you're not going to do it. Instead, what you're going to do with every dollar at your every dollar that's available to you is you're going to spend that money in a way that's going to make you look good as a CEO and help you get paid. The same thing with your board. And if you're an elected official, you're going to do what's best for your voters. And that's not spending it on infrastructure. That's the problem we're dealing with. The problem is that these infrastructure assets pay off over 20 to 30 years. And CEOs and elected officials are only in office for 4 to 5 years. So there's no incentive or little incentive looking backwards to take limited funds and put it into infrastructure. That's the problem we have solved for. We have fixed that problem, and we'll discuss that in greater detail. Next slide, Roy. So, Align identifies, funds, and manages the highest quality, lowest risk, unfunded green infrastructure projects. In other words, of the hundreds of billions to over $1 trillion in projects, our focus is let's find the lowest risk projects in the market, and let's fund those projects using external capital. And this is usually green debt or green equity, but it could be other sources of capital, including capital coming from the private sector. So that is our focus. We're not interested in projects with high risk and high return. There are many people in the market, traditional infrastructure funds, for example, from Carlyle, KKR, Macquarie, and others, that are focused on high risk, high return projects. There is literally no one in the marketplace today focused on low risk projects, low risk, unfunded green infrastructure. And there's literally hundreds of billions of those projects that are looking to be funded right now. And that's our focus. Next slide. So our long-term solution is to provide a fintech product, which allows us to continuously drive down our costs and deliver more value. In the short term, we integrate these different areas. We know we can become a company that's valued in the hundreds of billions by just executing on a more simplistic vision of what you're seeing here. But we think in year 1, 2, and 3, as we make investments in technology, that'll enable us to have a business that eventually has an enterprise value well in excess of hundreds of billions. Our competitors, and we have a number of them, are all trading in the hundreds of millions of dollars and more. They're doing very well, meaning their backlog, their pipeline, Their total invested capital is increasing by typically well in excess of 100% per year. So we're happy to see that they're doing well. But our biggest competitor today, without question, is the customer is doing nothing. And frankly, we never bump into a quote unquote competitor, even when we're speaking with the largest customers, like the state of California, the state of Texas, or a large publicly traded company. Next slide, please. So when we're focused on completing a low-risk project for a high-profile customer, unlike my days on Wall Street, when we were delighted to win 55% of the time, in our world, everyone wins when we provide a solution of upgrading critical infrastructure from old, inefficient, unsafe to new, uber efficient, green critical infrastructure. The customer wins, and by that I mean the employees, clients, communities, the environment. Leadership wins, that's political leaders, the CEOs, and Align wins. Not only your LP investors, not only the GP, but the operating company for which we're really having this discussion today, which is to be an investor in the OpCo. So if we sit down with a particular opportunity and discuss upgrading to green critical infrastructure, if there is a constituent around that table that believes that they're not winning, we move on. There's no sense working with them. There's too many opportunities for us where our involvement in those projects, literally everyone wins. Next slide, Roy. So I think this is the most important slide that you'll see today. And that is, as big of a market as this may be, or this is, it's actually beginning to grow at an increasing rate. And that's because not only here in the States, but especially in Europe, young voters and consumers are extraordinarily interested in ESG, green, and impact investing. And that is changing the dynamics of what we do. In addition, there is the ability to include a new type of analysis that allows us to harvest credits, be it carbon, water, tax credits, to monetize the benefit of improving your ESG rating. All of these attributes subsidize projects and help us move them from unfunded projects to funded projects, because it's no longer just a pure financial exercise of how much is it currently costing and how much am I reducing my utility bill. Every year at an increasing rate, these other variables are coming into the savings component of going from old to new. And that's accelerating our ability to move projects from unfunded to funded. There's also the asset as a service model that allows us to move the customer from old to new infrastructure without the customer paying for CapEx. So what we're doing is our LP investors own these assets, not the customer, and we're just having the customer pay for using those assets. So as we transfer from CapEx to OpEx, the customer no longer has to pay for these new assets. They only need to pay for use of the asset. The other substantial change that has occurred just since I've been in the business, and I've been focused in this space since 2015, is the cost of capital has dropped tremendously. And I'll give you an example. In 2016, when I was with my old company, we funded a project for a correctional facility. And we used capital from one of the largest investors in the world. The cost of capital was 20%. Today, that project would have a cost of capital probably around 3 or 4%. So there is, let's say it's at a minimum, a 15% reduction in the cost of capital for that project. Now, that might sound significant to most of you, but consider the following. This relationship with the correctional facility and the service component that we use in this asset as a service model means that the customer is paying a usage fee over the life of the assets, which is traditionally anywhere from 15 years if it's lights to as much as 30 years or longer if it's HVAC. So imagine this, for every $100 million in investment in that correctional facility, we are saving the customer 15% per year for 20 to 30 years on that $100 million investment. So the total accumulated savings is unbelievable. So that's one of the components of why this business and this opportunity is accelerating. Is there's been a tremendous drop in the cost of capital. And also, you might ask, well, why hasn't this business existed in the past? The next bubble describes why. You couldn't execute this model until all the various assets that you're putting into these facilities were connected by broadband and could be monitored 24/7, 365 and be metered for usage. So you literally couldn't execute this strategy until the last 3 years. Just like you couldn't execute Uber's strategy until cell phones had the capabilities that they had 15 years ago. No different. And that's why this is a new opportunity. That's why you haven't seen this before, but that's why it's going to scale tremendously over the next decade. Thanks, Roy. Next slide. So many of you are focused on long-term, what's our long-term competitive advantage? And the bottom line is we intend to fight like hell. Currently, all of our competitors, the few that we have, are focused on a private equity model, and their costs are substantially higher than ourselves. Our focus is to be the vanguard of green infrastructure, meaning the less we charge, the more they save. And our focus is on getting the value of the operating company to be a $1 billion plus company, not on optimizing the profitability of working with our initial customers on their initial projects, number one. Number two is that when we do work with a customer, we expect the amount of business we'll do with a customer will increase tenfold as the relationship matures. So, for example, I was with the largest correctional facility in the world on Monday, and the initial project size is somewhere between is 50 million and higher. I anticipate that over the life of that agreement, that eventually our total invested capital with that customer will be well in excess of $1 billion. And that's not unusual. That is the type of customer and the type of opportunity we're dealing with today. And oh, by the way, in their main headquarters, this customer doesn't have broadband, let alone have the ability to fund an upgrade to their HVAC. Next slide. So I'll go through quickly a case study, which we did at my previous company. So if this is a modest school district here in the States, actually serves a minority-dominated community. And we perform the upgrade of their lights and HVAC in a third of the time. This is what they would suggest is the appropriate. I would say it's probably more, a quarter of the time. that the school district could have upgraded their facilities themselves. It was 22 schools. So we upgraded their lights and HVAC system in a minimum of a third the time that they could have done it for themselves. We purchased their lights for 40%. In reality, we purchased better lights than they were purchasing for 40% less. So it's really not a comparable store comparison. And we purchased their HVAC for a minimum 15 to 20% less than the customer was paying themselves. So ultimately, not only did we do this in less time, but we saved the customer significant money in the process. So at this point, I'd like to stop here, take questions. What kind of questions do you have? How can I help you? We have an experienced team. We're excited about what we do. Our entire team was with me at my previous company. We left there to launch Align. How can I help you better visualize the business opportunity in front of us?
Maybe it would be interesting to hear what led you to pursue the business, sort of your background there.
Great.
You were obviously in the industry, so you saw the change and everything. Yeah.
So I think that the missing component of the old business and why I launched Align was one, whenever you make a bet on a new company, it's people. So I wanted to make sure that we had a team that understands risk, appreciates risk. After a career on Wall Street, 35 years, I started in growth, started on the sell side, transitioned to the buy side in 2000. I began to better appreciate that if you're going to generate, if your underlying strategy is absolute non-correlated returns, and if your focus is on generating absolute returns in any environment, you have to be strong with respect to risk mitigation. And I felt the only way to do that was to build the company myself. Our objective is for every LP to make money in any environment. And I see no reason why we can't deliver on that. And by delivering on that, we can constantly push our cost of capital down. So Roy, one of the reasons I left to form Align is because our investment process, we have to be better at it than everybody else. And that's my intent. That's our intent, number one. Number two is you have to keep the best people. We have to have an environment so that the best people stay with us. Because much of what we do is outsourced, but we need a core team that's exceptional. And given that we're not reinventing the wheel here, this is not AI. This is replacing HVAC systems, the old with the new. It's being done every day. We can recruit and retain the very best people in this industry. We don't need many of them. And we can get into that on a further question, but we need great people and we need to keep them. And my intent is to do that by not only pay them competitively, but we'll have the fairy dust in the options and equity in our business, which they can't get when they're a part of a traditional firm. Finally, I think value is important. Ultimately, I think in 5 to 10 years, this business is driven by an RFP business, request for proposal business. And the lowest cost, highest value player wins. And so we're starting today in developing the reputation whereby no one can do it for less and for less risk than working with us. And I thought we had to start the company like that today. That's what our business model, because you always raise margins, it's difficult to lower.
Right. And going forward, is the intention to focus on critical infrastructure specifically? If you look ahead years.
Right. And the reason we're focused on critical infrastructure is that if it's an airport, a school district, a hospital, you have to use your HVAC system you have to use your elevators and escalators or literally close the facilities. So owning those assets and charging based on usage, the customer is going to pay you. That's a utility-like agreement. And in my opinion, owning a 5-ton chiller at Miami International Airport and being paid based on usage is one of the lowest risk absolute return strategies that I'm aware of. And I've been looking at absolute non-correlated return strategies for 2 decades. I don't know of an asset I'd rather own than replacing the old chiller, which is probably 30, 40, 50 years old, with a new green chiller, which has a useful life of 30 to 40 years, where I can literally eliminate nearly every risk involved with owning that chiller through extended warranty agreements and through usage agreements. So I love the business, and I think it's amazingly scalable. So I'm not manufacturing that chiller. I'm not servicing that chiller. And but that chiller is now online 24/7, sub-second. And I can eliminate all the downside risk of that chiller's operation. And it has to perform. If it doesn't perform, they literally have to close they have to close a portion of the airport.
Right.
Other questions?
You want to continue? Do you have another slides? And then we'll pick
Sure.
up with more questions towards the end.
Sure. Next slide, please. So my team. So I have 4 full-time professionals on my team. I have an independent consulting professionals. I have approximately 10, all of which I've worked with in the past. I have an advisory board group, 6 which are noted in this presentation. I have another 4, again, all of which I've worked with in the past. Very notable, successful professionals. We have a CIO, a COO, and a senior partner waiting to join the firm. That will happen as soon as we are funded in this round. And they are all professionals that not only have I worked with, they've been very successful. They've all been in this space for a minimum of 20. They've all been in business for over 20 years, very lengthy track records. And we're ready to scale. A big component of what we do is outsourced, and I'll speak to that briefly. You know, when we work, I'll give you an example with a correctional facility in, let's say, the state of California, whom we are in discussions with. Every person that goes into that facility, they have to know, they have to have worked with in the past. And very specific to California Department of Corrections. If you're working within corrections, and let's say we're working with Texas Department of Criminal Justice, even though it is within that same space, there's a completely discrete group of relationships in and around Texas Department of Corrections, which is different than California. So what we do is we work with their best providers, the people who they have the greatest trust in terms of people. And we only put the assets in their facilities that they want. And California is very different than Texas. So it leads to outsourcing relationships, which we manage. And the benefit of that, and obviously there are some issues that develop from that, but the benefit of that is it allows us to have multi-billion-dollar opportunities, one with the state of California and one with Texas. And we don't have to hire those folks internally other than to oversee those relationships and make sure that the process and technology is in place that we execute each and every day for the life of those agreements, and to win new business opportunities for which, as we discussed earlier, I expect a tenfold increase in comparable store sales growth with those types of relationships. So you have photos of and descriptions of some of the people involved. You can go through those on your own. We are looking for an investment in the operating company. We are and would consider investment opportunities in our projects, though that is going to be very competitive. As you may have read today, there is an article on Total Energy, and Total is under pressure because of their core business and the negative attributes that it generates. And so they're looking to offset that with investments in other areas, and they're having difficulty doing that. Think about our solution. So instead of investing in the hope of offsetting their carbon footprint by investing in Africa and forests, et cetera, our projects are proven. There is absolutely zero possibility of greenwashing. When you upgrade from an old 40 or 60-year-old boiler to a new boiler in a school district that's serving a minority community, we can guarantee the green attributes. We'll have key performance indicators tied to each attribute, and that carbon offset and other attributes from that project can be harvested by organizations like Total. So we are very excited about our ability to find all the LP capital we need to invest in the type of projects that we're discussing here. And that's not just with the Totals of the world, but that also applies to Apple and Google and Visa and others who are issuing sustainability-linked bonds and other forms of green debt and social debt. They're going to be incredibly interested in the type of projects we do, because there's no if, and, a but about our deliverable. We literally know what we're saving in terms of utility costs and harvesting carbon credits and water credits and tax credits. And they will be able to monetize those benefits, and we will help them convey that message to their investors and to the public.
Very good. Can you help us understand sort of where the milestones the company have gone through and where you're at right now, and then also what the investment will enable and where you're going, basically?
Yeah. So we expect to be cash flow neutral by the end of this year or January. We have our customer number one has a minimum of 3 projects which break ground in 2022. So when they break ground, a number of these assets have to be ordered in advance because it takes 6 to 9 months to manufacture, deliver, and install these assets. So we expect to have multiple projects underway in 2022. We expect revenues from those projects could start as early as November. And if that happens, we could be cash flow neutral to cash flow positive before the end of this year. And we're looking for operating capital that would give us at least a 1-year runway under the assumption that those projects, for whatever reason, are delayed, which we don't anticipate they will at this point. But that's the mentality of what we're doing here. Our focus is the appreciation and value of the OpCo. And I say that because of the success that our comps have had. The firm I left, they just raised capital well above 5x from their last round. That's over the last 6 months. But all of our comparables have escalating asset values. And so I think it's more important to achieve a 10x return over a year for our investors than it is to achieve a 100% return in distributions because we're profitable. I think it's more important that we invest excess cash flow into improving our company and growing faster because our recurring revenues and our enterprise value is unusual. So, and by that I mean, by the way, in terms of recurring revenues, when these are utility-like agreements. So when we have customer number one and they would like us to do an HVAC upgrade, we expect to realize revenues from that agreement for the life of those assets, which are 20 to 30 years. So the recurring revenue in our business is extraordinary. We get paid, by the way, two ways. We have an upfront fee or a closing fee, and then we have a management fee. So we do have an upfront management fee. That helps us achieve cash flow neutrality quickly. And we do a number of things to do that. And then we have a management fee, which it's paid to us every quarter for the life of that utility-like agreement with the customer. So when we sign a customer, we expect to be paid over the life of that agreement, which is 20 to 30 years, typically. But our focus is to increase the value of the operating company by becoming the best-in-class solution in the space. The current raise is at $7 million pre, probably $9 to $9.5 million post. Our A round, which based on what our current expectations are and our visibility into projects 1, 2, 3, and others, is we'll be back in the market in 9 to 12 months, and we expect that raise will take place at a valuation that's probably $100 million or higher. Which is why our intent is to not raise much in this round.
And how much of the raise will go to business development versus, sales or building out things? Or do you want to describe that? Sort of what are you using the capital for in this round?
It's to bring the professionals on and improve our web presence, just the basic stuff. Right. Because we should have the cash flow in January to make other investments in people. And the only way we do the A round will be if I and our investors believe we can achieve another 10x return over the next 12 months by investing it in technology. Otherwise, we can develop this platform into one that's worth $200, $300, $400 million without a high-tech solution. But in order to develop a $1 billion plus company, I'd like to have a fintech solution, which is unusual in this space and can provide us with a long-term competitive advantage to anyone else by driving our costs down and delivering increasing value to our customer over time.
Good. Ron, do you have any questions or anyone else? Yes, I'll send out the presentation and a recording as well to everyone.
Yeah, I think in closing, to the degree that people, and I invite your questions. So if you would like to reach out to me after our call today, please do. Roy has my contact information. It's noted on the slides as well. So I invite you to do that. But what's so unusual after a 35-year career on Wall Street is that the value of what we're providing to our customer is extraordinary. I mean, not only we're looking at a project that if they don't do it, the cost of replacing those assets is going to increase on average 400%. So by replacing the old with the new, we're eliminating the potential of that 400% appreciation and what it's going to cost that customer in dealing with this problem later, number one. Number two is we're going to be, and again, I know we're dealing with, you're hearing things like greenwashing, et cetera. We are not dealing with greenwash related issues. We can prove without a question of doubt when we take something that's old and replace it with something that's new, that we're going to not only reduce their utility costs, and we can literally guarantee how much we're going to reduce their utility costs of power and water. But we know we're going to provide a healthier and safer environment for their employees and their communities. And again, we can guarantee that relative to what they have in place today. And we know and can guarantee the performance of those assets because the downside risk can be eliminated. We can offset that risk through extended warranties and through performance agreements with the manufacturers. I spent years looking for true, absolute, non-correlated return strategies that could grow and that could scale. And this is the best thing I could find. I can't find anything competitive with this.
And is there a plan to raise for a GPLP structure in the future? And if so, when would that be?
Yeah, so there is already a GPLP structure embedded in the operating company.
Right.
So if we're unsuccessful at convincing investors a year from now, when our total invested capital is $200-300 million under management on its way to $500 million, on its way to $1 billion. If we're unsuccessful at convincing our investors that we can develop a fintech solution, we can sell the GPLP, to one of many, and I've spoken to all of the traditional top 20 infrastructure players. They all would love an asset like this. But I would rather have this be a technology. I think our investors longer term see this as the Nest of the institutional marketplace. In other words, Nest was acquired years ago by Google for $3.2 billion. Nest was acquired not because of their installed base, but because they had a better understanding of what takes place in the home because of that Nest thermostat. We'll be doing the same thing. When we have chillers, boilers, escalators, elevators, lights, et cetera, and we're receiving and understanding how that data works, because we'll own that data, we think ultimately that'll be of great value to other technology companies. So that's why we have an OpCo. And embedded in that OpCo is a GPLP. Now, we'll have many funds for that GP. We'll have various funds for institutional capital as well as for retail capital over time that allow people to invest directly in projects that resonate with them. But longer term, we think it's our data and our AI that will create unusual value for this company. So yes, we have a GPLP now, which will allow direct investors, direct institutional investors, insurance companies, sovereign wealth funds, people that are investing in green debt and equity, to make direct investments into school districts, hospitals, universities. And to give you a sense of size, let's just take education. Here in California, unfunded deferred maintenance of K through 12, so school systems, California alone, is expected to be $100 billion over the next 10 years. So that's just school districts within the state of California. That doesn't take into account California Community College System, the largest community college system in the world. Their deferred maintenance is in the billions. That doesn't take into account University of California system. Their deferred maintenance today is in the billions. That's just the education market in the state of California. It's an extraordinary growth opportunity for Align, and we're going to harvest that in a way that everyone wins.
Very interesting. And of course, there is expansion opportunities to Europe and elsewhere as well.
Yeah. Yes, we've already been invited. There's a group that would like to be have a strategic investment in us, bring us to Europe, and we are not ready to pursue that yet. But that's a given in probably a 2 to 3 year time frame.
Very good. Anyone else have questions? Jay, is there anything else you think you should mention?
I just invite you, please reach out to me. I'm happy to have a discussion with any of you individually. So please contact me. We're very enthusiastic about what's taking place. And I wouldn't be doing this, and my team wouldn't be doing this if we didn't think we could build a very big, a company that would be highly valued.
Very good. Yeah, you can reach out to Jay or myself, and we'll send out the presentation as well for all of you. Thank you very much, Jay.
Thank you, Roy.
Very interesting.
Appreciate your time.
Thank you. Was there a question there? You had raised your hand.
Hello.
Hi.
Hello.
Right. Jay, I must commend your ESG practice, and I really appreciate the fact that you're thinking seriously about sustainability. So I just wanted to get into just a bit about your corporate structure. And by the way, my name is Regis Uzoma. I'm the Global Director of Communications and Marketing with the US Africa Trade Council. And we're particular about expanding trade between the US and African trade access. So in your stead, who runs the affairs? And should it happen that you're not able to run your company as you feel upbeat about today, what happens then?
Sure. So I'd say that, and I tell this to any potential investor, our success has nothing to do with me. Our success has to do with adding value. And my intention, I have every intention of making sure that we have a deep bench of people who can help this company help others. So when you're building a company, and I've called this the vanguard of infrastructure. When you're building the vanguard of infrastructure, it's not about popularity. It's not about being the CEO. It's about adding value. And that's why we've chosen to build a business that can execute for the customer at a lower cost, not only than any other competitor, but we can help them upgrade their infrastructure from old to new for less than they can do it themselves. That has nothing to do with Jay Jacobs, the CEO. We're going to build that type of company. Whether I'm the CEO or I'm the chairman or I'm no longer involved with the company, that's exactly what we're going to do. It has nothing to do with me, other than making sure that I recruit and we retain and we build the culture and we build the model that allows us to achieve those objectives. But ultimately, Jay is here today and he'll be gone tomorrow.
All right, thank you.
Very good, thanks. Right, I think we'll end it there. Thanks for the presentation.
Thank you. Have a great day. And thank you for listening.
Thank you.